Hey everyone, and welcome back to the channel. Today, we're rediving into a book that Warren Buffett called by far the best book on investing ever written. We're talking about The Intelligent Investor by the legendary Benjamin Graham. If you've ever felt lost in the chaotic world of stocks, this is the guide you need. Graham wasn't about get-rich-quick schemes. He was the father of value investing, a strategy that's all about playing the long game and making smart, informed decisions. So grab a coffee and let's unpack the timeless wisdom of this masterpiece. First off, Graham introduces us to a fascinating character, Mr. Market. Imagine Mr. Market is your business partner. Some days he's euphoric, offering to buy your shares at ridiculously high prices. On other days, he's in a panic, desperate to sell you his shares for pennies. The intelligent investor doesn't get swayed by Mr. Market's mood swings. Instead, you use his emotional state to your advantage. When he's panicking and selling quality stocks cheap, you buy it. When he's overly optimistic and prices are inflated, you simply hold or consider selling. The key is to think for yourself and not let the market's noise dictate your actions. Your analysis, not the crowd's emotion, should guide your decisions. Next up is Graham's cornerstone concept, the margin of safety. This is probably the most important three-word phrase in all of investing. What does it mean? It's simple. Always buy a stock for significantly less than what you believe its intrinsic value is. Think of it like building a bridge. If the bridge needs to hold 10 tons, you build it to hold 15 or 20 tons. That extra capacity is your margin of safety. In investing, if you calculate a company's true worth to be $50 per share, you don't buy it at $49. You wait until you can buy it at say $30 or $35. This buffer protects you from bad luck, miscalculations, or unexpected downturns in the market. It's your ultimate defense against losing money. Graham also makes a crucial distinction between investing and speculating. An investor is someone who, through thorough analysis, seeks to preserve their principal and earn a satisfactory return. Anything else is speculation. A speculator is essentially gambling, betting on price movements without a solid foundation. The intelligent investor, on the other hand, acts like a business owner. You wouldn't buy a whole convenience store without first checking its books, its location, and its competition, right? So why would you buy a piece of a company which is what a stock is without doing the same? You need to research the company's financial health, management quality, and long-term prospects. So, how do you put this all into practice? Graham advises a defensive approach for most people. This involves holding a diversified portfolio of sound, established companies and high-quality bonds. He suggested a 50/50 split between stocks and bonds, adjusting based on market conditions. The goal isn't to time the market perfectly, which is impossible, but to build a sturdy portfolio that can weather any storm. He emphasizes consistency, discipline, and patience. Investing isn't about the thrill of the chase, it's about the steady, methodical accumulation of wealth over time. The Intelligent Investor isn't a book of stock tips. It's a book that teaches you a mindset, a discipline for making rational decisions in an often irrational world. It's about protecting your downside first, understanding what you own, and having the temperament to ignore Mr. Market's daily drama. These principles are just as relevant today as they were when Graham first wrote them decades ago. They provide a timeless framework for navigating the markets safely and successfully. Thanks so much for watching. If you found this summary helpful, hit that like button and subscribe for more deep dives into the best books on finance and investing. Let me know in the comments if you read The Intelligent Investor and what your biggest takeaway was. See you in the next video.